Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Crillo. Today we have Jason Postill and Tyler Lekas. And Jason got started in real estate after ending his professional baseball career in 2015 and joining a publicly traded real estate investment firm that transacts over $46 billion annually. He then started a full-service commercial brokerage in 2019, specializing in multifamily throughout the Southeast before partnering up with Tyler. And Tyler began his career at First Investors, where he honed his skills as a financial advisor. In 2017, he pivoted towards the niche of mobile home parks, making his entry into real estate by acquiring a 55-unit park in Florida in 2018. And then Tyler and Jason have strategically expanded their company holdings to 697 units across the Southeast. And this growth has positioned their firm as Arkansas's foremost private owner of mobile home parks. So thank you so much for being on the show today, guys.
Hey, thanks for having us, Charles. Really appreciate it.
Thanks, Charles. Appreciate you having us.
Yeah, so give me a little background on each of you. I know I just went over there briefly, but about what you guys were doing personally and professionally prior to getting involved with real estate before we kind of dig into your business.
Yeah, so my background, you touched on a little bit there, the brokerage. Before that, briefly, just out of college, I played professional baseball for about 5 years. I knew that wasn't going to be a forever career, right? And I knew probably coaching wasn't the route I wanted to go after, and always had a passion for the real estate. And I heard I didn't have friends, family in the space really, but I heard a big leaguer my last year playing. He said he didn't make his millions playing baseball. He made them owning 1,000 units in South Detroit, apartment buildings. And I was like, oh, bingo, and so that naturally got me. I always had a passion just for, the skyline and the commercial buildings, but that really hit home like, oh, hey, after this, I like that idea. We're in the cities, we're seeing all these apartments. I'm just counting the windows like, oh, 2002, I'm just like, who owns these things? You start asking those questions, but got into the brokerage side. I learned that wasn't necessarily the route to where I ended up wanting to be, which is owner, operator, and build the passive income. But it was a great experience to cut my teeth and learn the ins and outs. And about 2018, I did go independent and still on the brokerage side, but wanted to get in owning these. I'm finding all these deals for everybody else. And I said, hey, it's time to start building mine. I don't have a 401k or a big savings, and it was time to get busy. And that's where I met Tyler. And the long story short, we landed our first 68 unit in 2020. It caught fire, and here we are. So
my name's Tyler Lekas. I'm one of the other co-founders over here at MHCI Group, and kind of where I got my background is I started out in the financial world. So I did basically I was a retail financial advisor over at First Investors, as you mentioned, Charles, and then I moved up kind of the rung to an institutional financial advisor. So I was still managing my retail book of business, and then what I was doing was I took on more like an institutional role. So I was working with banks, hedge funds, and I mostly did fixed income and debt. And then I was working 120 hours a week doing that stuff, trading different kind of global markets, and I knew there had to be kind of a better bang for my buck, so to speak, right? So my dad ended up actually sending me an article about mobile home parks back in 2015. I started looking into the asset class a little bit. Ended up quitting my job, shortly after that. Started looking at deals, et cetera, in the asset class. I thought it was a super interesting asset class because it seemed like there was lower operating costs than apartments or townhomes or kind of your traditional rentals. And then, but you had this asset that was owned by the resident, and that's the reason for the lower operating costs. But they also seem like stickier overall income as well, because they have got skin in the game, right? We're an apartment complex, you're just renting it. You can move from one apartment to the next, to the next, to the next. So anyways, it seemed like to me that was a really advantageous piece of real estate. So again, I started driving assets, kind of looking more into it, made my first purchase in 2018, met Jason shortly after that, and a pretty funny story. Maybe we'll go into it later, and then we basically we hit it off and got our teeth kicked in Florida for a little while, and then eventually bought our first park together in 2020 in Arkansas, and Katie barred the door because we came, and under contract right now on 281 units in Arkansas, and looking to solidify that spot as kind of the largest private owner there. So.
Very cool. Very cool. So tell us about your firm now. Are you guys primarily focused on Arkansas? What is really your investment criteria and strategy?
Yeah. I'll touch on the strategy, and Tyler, want to hop in why we chose Arkansas. For us, it's been, from 2020, Tyler had already owned a park, but when we started our search down here in Florida, like Tyler said, we were getting our teeth kicked. Yeah, a year and a half. We just could not get a deal done. These cap rates were compressing, just cash, quick close. These guys were coming in day one, hard, no, non-refundable, 100 grand. It's just, we just could not get a deal done. And then so Tyler had a wild hair in Arkansas. We'll let him elaborate on that market. But, the distressed, underutilized assets, just mismanaged mom and pop, right? We really capitalized on that opportunity early on, just picking up those 30, 40. I mean, our largest asset to date is 122 units, right? But those 40 units, 18 units, no institution's looking at them, right? Arguably under probably 300, 400, 500 units. And then the private investor, I call it weekend warrior, love them, right? They're making it happen. They're doing it, but taking down a 40 unit on their own is sometimes challenging, right? Not impossible, but so we just capitalized on picking up all those and grew that. And all those are, again, mom and pop in a secondary, arguably tertiary market where you're not getting a million brokers calling in. Yes, I have some broker experience, but we're hitting these guys direct seller, and they're thinking we're offering them some insane price, and then we're over here seeing these price per pads or cap rates, whatever metric you want to look at, that to us is home run. Every deal. So finding those mom and pop just mismanaged and just really distressed. These been owned a long time. That's really been the criteria. But small mid size. That's what we've been on.
What are each of your roles on the team right now? How do you guys break it up?
Yeah, there's a lot of overlap.
I'm more on the operations side, and as Jason was about to say, there is a hell of a lot of overlap. I've got to say, because we're really as you may know, Charles, employees don't really care. They're there for a paycheck and they kind of move on. You really have to kind of incentivize employees in a pretty big way for them to really start to kind of feel like the terminology is golden handcuffed to the job, where they're really starting to kind of think for themselves in the business and really starting to add value. And we're not quite there, but yeah, I mean, again, my primary role is really on the operations side, and kind of where I bring the most value to the business is really going to be with, since we do so many heavy turns, the construction side is really what's going to make or break those heavy turns initially. And what I mean by construction is really rehabbing the existing mobile homes or getting new homes on pads in a cost-effective way. I'll just give you an example. We have a very stringent pay schedule for our contractors. There was a subcontractor of one of our main GCs that threatened to sue us today because you didn't get paid. I had to, one of the main reasons I was initially kind of behind on schedule today. And he was screaming at me at one of the properties and yada, yada, yada. And he threatened to put a mechanical lien on our property, et cetera. So that's where I kind of add value. And it doesn't really take somebody with very much, intelligence, just some organizational skills and hard enough head. And that since my head looks like Hey Arnold, I got a pretty hard, big head, that I can usually do well with those guys. I can just tell them no and good luck. And, you're not getting any money out of us without progress and the project being done, and we pay on a weekly schedule, et cetera. So that's kind of where I drive value. And then obviously all the nitty gritty in between. I'm on site on properties dealing with managers that quit, or dealing with managers that we had an issue with a manager that stole all the appliances and all the cabinets out of the home she was living in. So I deal with all those kind of those nuances where you can't really pay an employee enough to kind of drive around and do what I do for at the scale we're at right now. So that's kind of my job.
Yeah. Yeah, that's interesting. It's one of those things with dealing with contractors. You have to keep them on track or they will take advantage of you. And I'm not saying like all contractors will like this. I'm just saying that certain ones that you have that schedule and you have to stick to it, whatever kind of progress they're making. And I don't know, it can be difficult. It's a little daunting the first time through, but it sounds like, Tyler, you've done this a number of times. But one thing that you mentioned is that, which I kind of want, this is always one of those nuances that I hear from mobile home park people when we have them on, is you talked about renovating homes and about putting homes on property. So when you're buying properties, is there usually a high percentage of these homes that are there that you guys are actually buying? And what is your business plan there? Are you renovating them, trying to find people? I imagine you're not trying to just rent them out. You want to sell them to people. How does that usually work in your business plan? And because I imagine you can't have it every time perfectly. Everyone is rented out. You don't own any of the properties. I imagine you own some of them and you're renting some out. You're trying to sell some, on and on.
Yeah.
Yeah. So, sorry, Jason, go for it, man.
Go ahead, man.
So basically, it's definitely an interesting question, and that's what's going to make or break most operators, right? That question right there, unit. What is the unit count in each one of your properties, and how is that unit count broken up? And what is your plan to get those units, whether it's a park-owned home, and just for your listeners out there, and Charles, if you don't know yourself, a park-owned home is a rental home. So that's where the operator actually owns the home and they own the dirt underneath the home, right? So and you take care of all the toilets and issues and maintenance and everything else that goes on in the house. And then there's a different type of home, which we like better, called a lease with option to purchase home or a rent-to-own home. That's where you basically say, hey, for a low down payment, you basically get to lease with option to purchase this house. However, the lease, it's like a triple net lease almost, where, hey, you get to take care of the repairs and maintenance of this house until month 60 or month 48 or whatever it is, when you own the house yourself. And then really the repairs are on you. You just pay us lot rent and we move on. But again, those types of nuances really make or break, because, a lot of the parks we bought that a lot of other people didn't want to touch, and then we got a really good discount to what other people were buying stuff at, was because we took on park-owned homes, because people hate the rentals. And they hate the rentals for a good reason, because the people that live in mobile home parks that are in rentals are the worst type of renter on the planet. Hands down, I'll take a D-class apartment building any day of the week, and we can have that debate. So we try and convert those. And the conversion is difficult. It takes, a specific type of patience and longevity, and you got to have a really long time horizon, and you got to have, kind of a system of going around and, converting those renters and pushing that on them, kind of like a drip schedule, just like you would with a potential investor or a lead that's looking to sell a property. So again, those things those nuances will make or break a deal. But you are correct. Majority of the properties we bought in Arkansas have had a lot of rental homes on them. We have done a decent job of converting those rental homes. About 12% of our property or our portfolio right now is park-owned homes or rent-to-own homes. And so about 88% is tenant-owned homes. And we do own one deal that we bought for, it was 122 spaces. We bought it was 100% occupied, 100% tenant-owned homes, and that property operates at about a 23 to 25% expense ratio. The rest of our portfolio, just to give you a heads up, operates at about a 40% expense ratio. So if you can go in and buy a tenant-owned home or a tenant-owned home property, the reason those properties are going to be trading in 5 or 6 caps, because everybody that's buying those knows there's no headaches, right? And the management is just super, super low, right? So if we can find more of those deals, we'll jump on them, but they're far and few between. So Jason, did I miss anything there?
Nailed it, man.
Jason, when you're dealing with investors, when you're talking to them, I mean, and you're going to get investors that are in all different types of asset classes if they're within commercial real estate. So why, just high level, I mean, why choose mobile home parks over other asset classes? Like, why do you see that? You're someone that was involved in multifamily before selling multifamily. So obviously you believe in that asset class as well.
Yeah.
And then you've pivoted to this. So tell me about why, how do you sell this to an investor, and what are some of the perks that you see that maybe are left out of other asset classes?
Yeah, and I get asked that frequently because we don't, apartments a sweetheart, right? Lenders, that's always been a sweetheart. That's how I cut my teeth. But just really analyzing. I still love apartments. It's just just really analyzing and just looking at, okay, what's the most recession? Nothing's recession proof, right? But like just looking at, okay, our average lot rent across our portfolio, $350 lot rent, right? You can slap that on a credit card. It's tough for some of these, if affordable. They might not even have. If they're paying $2,000 a month on a one bedroom, that's not affordable, right? So just looking at the demand, we always hear solve the affordable housing crisis, and then what are they doing? They're trying to condemn parks like ours and bulldoze and put up an A-class apartment that is $2,000 a month for one bedroom. So just really analyzing the different asset classes. I mean, storage is a top one, but just seeing that these big boys coming in and crush you with a pay per click. If you're a smaller guy, like run you out of business. It's just again, this is a subjective, it's an opinion, right? But just really studying it, housing, that was at least the major food groups, right? Retail, industrial, just we're behind food, water, and shelter. Here we are, right? So just narrowing it down, that was really what sold me, and just seeing probably early on, it was to a competition deal, right? Everybody was after the apartments. Then I was saying, okay, this might be a lower barrier to entry, and now it's obviously a more hyper competitive asset class, but it was a combination. But yeah, it just the affordable housing and the demand. I mean, that just was a feel good asset class for me, for sure. And the last note on that is, after analyzing all these apartments and different asset with these expense ratios, just originally hearing, oh, you just own the dirt. For your listeners, that's not the case, by the way, right? This is a very active role. So it's not, but it sounded good. And it made sense when you hear it, like, oh, you don't own any of the homes, that the tenants own them, and we just collect on the dirt. And I was like, oh yeah, that sounds amazing. And that's far from the truth, but it's a good concept. And yes, when you do eliminate the park-owned homes, there is a less management. Tyler mentioned our portfolio. That's a superstar asset, 24%. Usually when I see that in a broker package or an owner tell me, I'm like, BS, you're full of it. There's no way. But it is possible having those all tenant-owned homes, direct build, and combination of things, for sure.
No, that's great. Like when Tyler was explaining it, he was saying, and he said then 12%. And I thought how he was explaining it was going to be a lot higher than 12%. 12%, I would think, is very low. But, you're compensated by the value add, and that's in any asset class or any business. So, you guys are going in there and you're taking on problems. And Tyler's out there, making things happen in the field, getting these things sold over to people, tenants that are already in there. So that's great. Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carrillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. So one of the things I see is that when I hear from mobile home park investors, one of the other challenges, so you have park-owned homes. The other thing I see is that like infrastructure on these properties. So are there, maybe go into that slightly, and then also like what other challenges are you seeing out there? I don't know, Tyler, maybe you can explain more of this, whatever it is that you're seeing with home parks that maybe you have to be really aware of and that you've gotten more aware of over the years.
Jason, you want me to take the utilities?
Yeah. Take the utilities.
Okay.
Yeah.
All right. Yeah. So, private utilities, those really scared us initially. I have to say, we actually just got a property. So I did a whole LinkedIn post about this. If you're looking to, for a bedtime story, I did a whole piece about private utilities and I ranked them by risk level and everything. So if you're looking to go to bed, feel free to read that. It's on our LinkedIn page, MHCI Group. So, but basically, your least amount of risk, obviously, is your city utilities, city water, city sewer. The city is going to charge you obviously more for that, for being on their utility system, but there's little to no risk. I would say that, just kind of going to your second question and segueing into that, you got to look at the infrastructure of your asset. You got to do a sewer scope before you buy it, because we've probably replaced, between all of our properties now, we've probably replaced 25,000 feet of sewer line, maybe more, between our 700 units. Because and I always when this was happening, it wasn't so funny, but looking back on it, it's kind of funny now. I remember taking a photo of and sending it to Jason of this video. We were doing a $3,000 sewer project, like 4 or 5 months into our first deal that we ever bought, and we had to spend like $6,500 on it. And it was like breaking us. It was like breaking the bank. Like, we didn't it was not part of the plan. We'll put it that way. And we found Orangeburg, clay tile, cast iron, Schedule 10 PVC, and what was it? And cement sewer pipe. So we found 5 different types of sewer lines in basically 3,000 feet of line. And it was wild. So the sewer infrastructure, even if it is on city water, city sewer, you got to do a sewer scope on it, because a lot of these parks were built in the 50s. And I think that catches, and it caught us with our pants down, a lot of operators off guard on that, right? But again, it's still the safest type of utility system if you had to pick one, right? The next one down from that is going to be septic tanks. We have a park with septic tanks on it, so it's on city water, but it's on septic tanks. And then again, the septic tanks to us are pretty low risk, especially if if the septic tank blows up and not the leach field. It's really easy to replace it. The leach field blows up and you've got a really strict health department, like you're in California, you got to be really wary of that. But again, they're pretty easy to kind of swap in and out. It's not going to be a deal killer, for you. Kind of the next one down from that is going to be a package plant. A package plant is really where you almost act like the city, right? So you've got your own wastewater treatment plant, package plant that actually filters and cleans the water. Then it comes out a little tube, usually into like a stream or something. And what happens is that basically you're cleaning the sewer on site. Again, though one of those blows up, that could be $500,000 to $1 million. So that could kill your project, especially if it's a 50 space property, right? I mean, think about that. You spend $500,000 on sewer infrastructure for a 50 space property, paying you $300 a month. Like the property may only be a couple $100,000 more than the actual sewer infrastructure. So you really got to dive down deep on due diligence on those. And then the most risky is going to be a lagoon. And we're actually under contract on a property with a lagoon right now, but we have, we're getting it at a crazy low price per space, and we're going to raise the capital to go replace it if need be. And the due diligence we're going to do is going to be, we're going to do every piece of due diligence we have to on that lagoon and dive down the deepest you could possibly go. When it was built, all the mechanisms that basically a lagoon is really just like a big, you got solids that float to the bottom, liquids that float to the top, they burn off, and then you got to get basically the solids cleaned out every once in a while. So it's a pretty, Fred Flintstone way to collect your, pretty caveman way to, collect your sewage of your property. But it's definitely, it's very risky because a lot of cities are getting rid of them. They're actively getting rid of those. And if you don't have city sewer near your place, they'll make you connect. So if it's a couple miles away, that's multi-millions of dollars. you're going to default, right? And they're going to tear the park down. So, Jason, I miss anything there?
No, the sewer, yeah, it can be a nightmare situation. So if you're not doing your due diligence, then yeah, you could run into some big problems. So yeah, we've definitely done both. So we do the sewer scopes.
And Jason, did you want to elaborate on?
Oh, other problems?
Sorry, I was going to say, Jason, do you want to elaborate any more on the the pieces that maybe operators miss? Due diligence or otherwise.
Yeah. I mean, something investors too. I think the second piece is what should investors look out for, right? Like, I'm sorry if you hear that noise here. Yeah, I mean, just even on the it depends. Is the investor, is he trying to be a mobile home park owner or just an investor as a limited partner, right? Because those are obviously two big lenses. If they are trying to acquire a mobile home park for themselves, again, realize this isn't just some passive investment. If you're trying to be active and just think, I mean, we buy a lot of these from doctors and high net worth guys that think like, oh, hey, I'm making a lot of money, here we go. And then it's mismanaged and it's not as a passive role, right? So, on that side, just really understand it. It's not, if you are investing, just look at your operator, right? Never own an apartment building, right? So I'm not saying it's an easy, but if you do the old Google search on management companies, there are a dime a dozen on apartments. Well, in mobile home park land, not so much, right? So we've had to vertically integrate that team, which is very challenging, right? Because it is, financially, really, it doesn't even make sense when you're taking 5 or 10% on $300 lot rent opposed to $18 or $2,000, right? It just, from a business standpoint, doesn't make a whole lot of sense for third parties. So, that's one thing as an investor, even just looking to invest, like, hey, are these guys just operating off some pro forma deal, or are they operating off a true property management plan, right? Because that is the lifeblood of this business is, we love deals, we put them together, but it's, how's this thing getting managed? It's not just we're painting a building, putting, increasing rents. There's a lot more moving pieces, right? Selling the homes to the tenants, the park owned home. That's probably one of the bigger challenges is that conversion, right? That we touched on earlier. So, during due diligence, that's the big one is just the sewer. Other big problems, just seeing if what the seller is telling you is accurate, right? I know that sounds like common sense, but sometimes they don't even know. For example, one of our top performing assets, it was a smaller 33 unit. Well, that was originally a 39 from the seller. He said, oh, it's 39 sites. Tyler walks, he goes, this is weird. There's 33 pads. Seller's, oh, well, I don't know. That's weird. It's like, oh yeah, that is weird. You've owned this for 25 years where they just vanish, so that's a big change in your underwriting. So, just really not just taking word for it, right? And just really diving in. And I guess the other thing is just, cash pay. I bring this up to apartment guys. I've talked about it a couple of times. It's not even a thought, like, oh, payment switching, right? It's not even thought about. Usually in apartments now, everything's online pay, but where we've had our first deal was all cash. And we said, and it wasn't even put in the bank. And we said, well, how do we do this? Well, Tyler and I had to fly there, sit in lot 3 where everybody was coming in from the 3rd to the 5th. And we literally had to watch cash change hands because how do you confirm that otherwise, right? Like there's just things where you're not really thinking of that you would have to do. And then you get in these situations. And if they write down on a note card that Sally pays $400, how do you prove that, right? So just those little nuances are a big deal that go overlooked sometimes, but you learn quick what to look for. So
yeah, not all the cash is making it to the bank, so it's difficult to do that due diligence when you're doing it. I've worked with apartments like that before, and it's difficult. It's a difficult way of trying to confirm that, and there's only so many ways you can do it. But that's Jason, you mentioned earlier on about how you're finding mobile home parks, and I imagine a lot of this is since you are kind of nuanced in working with brokerage, and I imagine going straight to owners is one of the things that you guys do, and I imagine that goes hand in hand with how you're financing these deals. So if you mind just briefly going into how you normally find deals, and then what are the lending solutions available to home parks today, mobile home parks?
Yeah. So our approach is always direct Yeah, and having the brokerage background, obviously going direct to seller, we know how to get them on the phones. And it's still to this day a tactic. I'm cold calling, setting the meeting, Tyler's meeting 'em. I mean, we still are to this day two-man balancing. We are obviously leveraging brokers and some other resources. So we're trying to work on the business, right? Instead of in it so much. That's always tough, right? Because I enjoy part of that, putting the deal, Tyler's meeting them. But yeah, I mean, that's really 80% of our deal has been, once we landed that first 68 unit, that ended up being an owner finance. So I'll probably blend some of the financing and the acquisitions. And Tyler, you can hop in here too with the banking. But yeah, it's once we landed that first one, just, my always assignments was, hey, first deal, then the easiest call is next door, right? You start just calling around the block. And now that you own, now you're aligning yourself. It's not just a broker call, right? They're not just getting inundated with, hey, I want to sell. Hey, I got a 1031 buyer. Or hey, it's like, hey, I own right across the street from you. That's a way warmer call than, oh, hey, I want to sell your park, or I have a buyer. It's like, hey, I own down the road. I wanted to introduce myself, and we own. We're neighbors, and and when you're ready to sell, we'd love to send you a strong offer. Oh, really? Well, and then that's how it started. And then it was the next, I think, 5 deals. They were individual sellers. And it was literally just cherry picked just around the block. Again, a direct call. Tyler would meet them. The good old boys club, it's not like down in Florida, New York, where they're used to it, just on the phones. It's hey, I want to shake your hand and meet you at the table and, have a beer or whatever it is. So that's really how those got started, and they're tough to finance, right? So that's why that first one was an owner finance, 50% down. We raised the equity, brought in some of our personal capital, and got the deal done. And then we realized that every other deal isn't always going to be financed. So we started building those relationships with small banks, because most lenders won't touch a 500, or we had one deal, it was 22 units, 248,000. Where are you getting that loan from, right? It's a mobile home park. There's some park-owned homes. It's 250,000. Who wants to spend time on that as a lender? It's not worth their time. So we started developing relationships with local community banks, where they started seeing, wow, you guys have a business plan. You're here, right? And that's where Tyler's in town, meeting them. I'll come in every quarter or 6 months. I'm probably in the way more than anything, but it's good to get some FaceTime, and those small community banks has really been where we've grown, because they see the deposits. They see, hey, these guys are making payments on time, like what they're doing, and a lot of other guys aren't lending. So these small banks actually love that opportunity to even get those deals done. So, Ty?
Yeah, I mean, it's the lending situation was interesting initially. Really building relationships with those kind of local and regional banks. Really was the only way we got our first couple of deals done. Without those local banks, we never would have got a deal across the finish line. The amount of times we got told, oh, it's a $2 million minimum asset price, minimum purchase price. So a $1.4 million loan. I mean, nobody wants to lend on a $200,000, mobile home park, and this really awesome. We still got to relate. Actually, we're getting a line of credit from him shortly. But he was the lead lender at this bank called Gateway Bank here in Arkansas. They got 2 branches, and he goes, "We love $200,000 deals." He goes, "We don't want to lend any one person or any one organization more than $1.2 million." So in total. Right. And so it was great. We still have a good relationship with them. And the other interesting thing about kind of those local and community lenders is they're going to take, a lot of your underwriting at face value, and kind of what where you kind of see pro formas. They're not the most sophisticated bunch. So it allows you to kind of dictate the terms that you want, construction loans, et cetera. And they're really malleable if you put together a good presentation. I'm sure you've dealt with this, Charles, as well. So I'm saying this more for your listeners. There's people that will let you, kind of hear you out. Like the smaller the bank, the more chance you have to kind of go to the top dog. They probably only have one guy that underwrites deals, and he probably has never had any experience with mobile home parks, right? So it was definitely those local and community lenders saved us at the beginning there. It's good. So.
Yeah, it's one thing that I have found, and when I speak to, if I'm mentoring someone or whatever it might be, and in my experience, anything, you go with some of these larger banks or your, government sponsored entity type lenders, agency lenders, and they want a stabilized deal, $1 million loan amount, all this stuff, right? If you're dealing with any type of unique property, and I would consider, old mixed use properties or small apartment buildings, or mobile home parks as unique properties, because that's what I used to buy a lot. And it would be something that it was, they would work with you. They knew the area. They'd come and see the property, right? Like you're never gonna, like, people are like, oh, I found this lender online. That lender is not coming to your house. They're not coming to this property. They don't care about it. I'm dealing with someone, and it's usually like a 3-person credit committee, like local. They've driven by the property. They're going to stop by on their way to lunch. I mean, this is how you build relationships, and these community banks are instrumental to properties that are smaller commercial properties that are maybe don't fit the box of the traditional lender. And like, so anybody out there is trying to finance anything, speak to local banks, credit unions, and, see if they have an appetite. And if they do, open up your accounts like they do, their bank accounts there, LLC accounts, all your stuff there, build that relationship. And that's how you're going to get great. That's how you're going to get great financing for your properties. That's just my take from my experience.
They want to lend money. That's it. I mean, that's their job, right? So you find those new banks and they're hungry, and they see somebody else hungry that has a good business plan that they can execute on. I mean, even if you didn't have a track record, right? There was a time we didn't have that track record. So it was showing them and just, building that relationship. So it's worked out.
So as we're kind of wrapping up here, guys, I just want to say, you had some great advice about doing, about your, doing due diligence on properties, finding deals, getting them financed. What would be, high level, maybe give me your couple top main advice or key takeaways from your experience over the years that you might give to a new investor that wanting to actively purchase a mobile home park or possibly passively invest in one. Just kind of food for thought.
Yeah, I mean, one of the big things that I would say is, if you're buying, heavy value add, so you don't have some big institution behind you or some big private equity shop, your last name, isn't, Gates or Zuckerberg, then, you're going to have to go after those higher yielding assets because you're going to have to deliver something to your investors, right? That's just the way it's going to happen. And if you're buying heavy value add or even light value add, you're going to be dealing with park-owned homes. And, again, if you're in Orlando, Florida, Chicago, Miami, Los Angeles, the big primary markets, park-owned homes fly off the shelves. They do, right? You can go sell handyman specials all day because the single-family home prices are so freaking high. So if you find a good deal in one of those markets, by all means, don't take this advice. But if you're buying in Little Rock, Arkansas, where it's more tertiary and you're gonna have to put a little more work in, or like Ann Arbor, Michigan, or Indianapolis, right? A little less stronger, probably secondary, tertiary markets, where a lot of guys get their start. You're going to have to go out and overraise on the capital expenditure side, especially in your first deal, because you are going to run into a number of problems with heavy turnarounds, and you're going to have to overraise for that, or you're going to have to, take money out of your piggy bank to make the deal whole, because you're going to run into sewer problems. You're going to run into water problems. The costs are going to be more than your contractors told you initially because, they were high that day or they just got out of jail or something. They're the worst. Contractors are the worst. You're going to have to build out subs. Things are going to take longer, right? So if you think it's going to take 8 months, build in 15. If you think it's going to take 15 months, put in 24. If your investors are not comfortable with that, or that doesn't work for your timeline, then pass on the deal, because you're always going to need more time, and you're probably going to have to build in a 15 or 20% margin as well for your capital expenditures. So that's what I really recommend. That has been, thank God Jason and I had enough capital in our own accounts for our first deal, because we ran into a number of those problems, and we fed that deal when we went over budget. Thank God we didn't put anybody else in the line of fire on that, but it was an eye opener for us, and then we really dialed in those costs, right? Another thing I'd recommend, besides just the regular due diligence, is if you're buying a small park, you better have either an operator on the ground that's an owner that can act as your manager, right? Or you better have scale within the area to build out in. Because a small park is never going to be able to support a manager, a $50,000, $40,000 a year salary. Again, you guys, everybody, all the listeners out there, you guys can do your own math. But at 20 space property, paying you $300 a month, right? The entire net operating income, probably for the entire year, would go to your manager then, right? So that's not including debt service or anything. So it's just the economies of, you need economies of scale to then build out that management team. And if you're looking to buy yourself a job, again, don't take any of my advice on that, but you got to have economies of scale in this business because the lot rent is just not enough to support any sort of living wage. And trust me, if you're building any sort of scale, you want managers on the ground that want to keep their job, that are interested, because having bad managers makes your life a nightmare. It makes your life a living hell. We've had managers that threatened to burn down our houses they've been living in, pour concrete in their sewer lines when they were leaving, steal stuff, etc. So we underpaid those managers, right? And we underpaid them because we didn't have economies of scale at the time. So those are kind of my key takeaways. Look, overraise, give yourself more time, and have some economies of scale in the business if you're looking to build a portfolio.
Well,
Jason, anything to add while we close up here?
Yeah, I mean, the short one on mine is, really it just come buy right? We talk about that all the time but we buy right. And I can see how guys can get desperate, right? Where, especially those 2 years we were getting our teeth kicked in. It's almost like, we want to overpay and just, we have not done that, and we got asked actually a couple weeks ago, investor, we got a big raise right now. Hey, have you lost anybody's money? No, thank God, right? Knock on wood. Have you guys had a capital call? No, thank God, right? So we've done that by buying right, and not getting, I've had a mentor kind of sticks in my head is, greed will make you bleed, right? And that kind of stuck home. And you also coupled that with, hey, a bear will always make money and a bull always make money, but a pig will always get slaughtered, right? So just understanding, hey, don't get desperate to a deal. Don't just make emotional decisions here. Because again, going back to that, and guys that are trying to get into this, it's competitive, and sometimes some emotions can take over just to get that first deal done. But yeah, buy right. We just make sure we're buying right, and whether you're an investor buying your own deal or investing with an operator, just really understand what the deal is and not just focusing on some 3x multiple and some pie in the sky IRR that is so subjective, right? 5 years down the road, but yeah, buy right. That's it.
Fantastic. Well, yeah, that was the first thing. One of the first things my dad taught me in real estate was the money is made on the purchase. So thank you so much, you guys, for coming on today. How can everybody learn more about you guys' company and what you guys got going on?
Yes, you can.
MHCIgroup.com. We're always on email. Yep. Jason at MHCIgroup.com. Tyler at MHCIgroup.com. And
oh yeah, you can. We've got MHCIgroup.com, and we also have a LinkedIn. Like I said, I think we post some pretty funny content on there and some pretty interesting stuff. Jason's kind of more on the investor side of things, so syndication structures, what you should know as an LP, etc. And I'm kind of more on the operations side. So I tell funny stories on there sometimes about our tenants that are female that look like Brian Urlacher or Mike Tyson that try and take a swing at you and fall in mud puddles and some other stuff like that. So people might find it entertaining as well as insightful on kind of what you have to do on heavy turnarounds. So check out our LinkedIn pages. You can just find us on there. And then you can also email us at Tyler at MHCI Group or Jason at MHCI Group. So.
All right. Well, sounds great, guys. Thank you so much for coming on today. I will put that information, the contact information, in the show notes. And I'm looking forward to meeting you guys sometime face-to-face here in the near future.
Likewise, Charles. Thanks for having us on. Really appreciate it.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.